But look, there are real concerns about the way DeFi functions right now. Have been a lot of hacks, rug pulls, all sorts of concerns. Just last month, we saw the lending protocol Euler Finance suffered an exploit with nearly $200 million being lost. Of course, Chainalysis has said that at different times last year, we were running at record levels of hacks. What is the right way to deal with that, right? Is this motive for the SEC to get in there and protect consumers, or is there another mechanism for how we can protect people from these kinds of ongoing risks?
Well, I think there are a couple things to bear in mind here. One is, if we're not dealing with securities, then it's not the SEC's job to fix it, unless Congress expands their jurisdiction and gives that to us. The true DeFi, though, is based on open source code that everyone can see, that everyone can understand the terms before engaging with it. And it really is peer-to-peer or peer-to-protocol. And so if that's the situation, if you're choosing to avail yourself of that, my argument would be that the technology itself is sort of a substitute for many of the regulatory protections that you would need, or that we typically provide in the United States when you interact with an intermediary, with a centralized firm. So I think it would be wise for us to set true decentralized protocols aside. And it's not to say, as you mentioned, you can get hurt if you interact with those. You can lose money if you interact with those. But I think that you're opting into that when you're entering into decentralized